So what if I told you I know a company in which if you put money, you can double your money in 25 days. Every 25 days, the money doubles. The only thing is you cannot ask me what the fundamentals are, what the company does, or how much money the company owes to investors. I mean, that's the quickest way to becoming a millionaire, all right? So who's in? This may be a little bit of an exaggeration, but unfortunately, this is how a lot of people are investing in the current stock market. No research what a company does, just getting into a company just because some famous YouTuber is in it. But what they don't know is that YouTuber has a lot less skin in the game even if that company goes bust.
Yeah, boy.
With that, I take on the responsibility of passing on some non-clickbait, real unbiased, no skin in the game information. Hi guys, this is Nitish aka Investologist MD, and in this video, we'll be starting a series about the ins and outs of stock market, starting with what a stock market actually is. If I were to ask you, what was the oldest stock market, would you say New York Stock Exchange? Or maybe London Stock Exchange? Maybe Shanghai Stock Exchange? Or maybe Bombay Stock Exchange? All these guesses are incorrect. The actual answer is this. This symbol stands for Virengi VOC. Alright, let's just call it VOC. But in fact, this company is more popularly known as the Dutch East India Company. Now let us not confuse it with the East India Company, which was British. Now, although the Dutch East India Company, formed in 1602, was 2 years younger to the British East India Company, it scaled up quickly to almost 10 times the size of its British counterpart, and at one time was conducting business for almost half of Europe because of this one strategy. This one strategy is followed even now by modern companies made either privately or under some stock exchange, and that strategy is issuing stock to attract investors and getting more capital for the company to grow. And by doing this, which was a groundbreaking strategy at the time, the Dutch East India Company, or VOC, unknowingly became the world's first modern stock exchange market. Now, to understand how a company is funded in the modern era, let's understand what a startup is. A startup is a company which is still in its initial phases of development. They usually barely have any revenue, so look for outside investors for capital. Now, there are 8 stages of funding for a startup. There's the pre-seed funding stage. In this stage, the company is mostly just an idea and the funding mostly comes from family and friends. Then comes the seed funding stage, in which the company actually has a few customers. Next are A, B, C, and D stages of funding, in which venture capitalists come in, and with every subsequent funding series, the amount of funding and the expected growth increases. The next are mezzanine funding and bridge loans, which are primarily for ensuring enough capital for a smooth IPO. And finally, what every startup company aims for, the 8th stage, is IPO, or initial public offering. It occurs when the shares of the company are up for public purchase. The funds generated from IPO are either used for further growth or allowing the startup owners to sell some of their shares for personal income. And this selling is why usually you'll see a sudden drop in share price right after IPO. So now the company is IPO'd and its shares are listed on the local stock market for public purchase. Whoever purchases a stock, also called equity, owns a small slice of the company. The hope is that as the company does well, the price of the stocks are going to go up and they can eventually sell it for a profit. This sounds good in theory, but in actuality, the stock price can be disjointed from the company's actual revenue. Let me explain. The company might be running a losses, but the stock price might be still 10xing, something like we saw for Tesla initially. And then the opposite also true, that the company might be doing really well, but the stock not so much. Something which is frequently seen in after hours when a company reports really stellar earnings, but still the stock prices fall. Now, why does this happen? It is because of the principles of demand and supply. As the company does well, the demand for the stock increases, and as the number of stock in circulation at any point in time are finite, that raises the stock price. And the vice versa also happens when the general consensus surrounding the company is that the company is not doing so good, the demand for that company falls, and thereby the share price also goes down. Now, these are just people deciding what the company is worth. I want to add here that it is human tendency to be overly optimistic or overly pessimistic, because it gets difficult to detach emotions from expectations, especially when our hard-earned money is involved. Now, this cycle of optimism and pessimism can be either related to real facts, like Fed's changing the interest rates, or a pharmaceutical company developing a groundbreaking and life-changing medicine, or it could be sometimes secondary to no real facts at all. Like when this happened, when on January 7th, Musk tweeted the words "use Signal," referring to an encrypted messaging app as a alternative to WhatsApp, but the people ended up buying Signal Advance and the company's stock price jumped 6,350%. That just blows my mind. Because of the cycle of optimism and pessimism, the stock price movement is never linear. Rather, it has this wavy characteristic in its short-term price movements. By the way, if so far you're finding value in this video, please hit the like button and consider subscribing. Moving on. This paper, which came out in the International Review of Economics and Finances in September 2020, reinstated that human confidence has the power to trigger anything from economic booms to financial crisis. This erratic, unpredictable stock price action is why day trading rarely works out, and this is also the reason why most financial institutions recommend long-term investment for general public rather than going for a quick buck, especially for people who cannot be glued to the news and cannot make quick decisions of buying or selling based on every single sneeze. Then comes supply, which is largely determined by either share buybacks, which will decrease the number of shares in circulation, thereby bumping up the stock price, or when the company ends up making more shares, also known as share dilution, thereby increasing the supply and bringing the price down. Share dilution usually happens when a company needs more capital, it creates more shares and sells it in the stock market for that money. In this scenario, the price of the share goes down, and if it was a dividend-paying stock, the amount of dividend paid per share also goes down. Warren Buffett famously said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." It implies that in the short term, the stock price movement can often be determined by how popular or unpopular the company might appear at the time. When markets behave like a voting machine, they tend to ignore important things like fundamentals and are largely based on sentiments and speculations. Example, the everything rally in 2020-2021, where stocks, bonds, golds, NFTs, cryptos, you name it, everything surged in tandem. Even companies running extreme losses surged like anything. For example, those Reddit and meme stocks. But in the second part of Buffett's saying, he believes that in the long term, the stock price movement will be largely based on the company's fundamentals, including companies' earning growth potential, financial strength, competitive advantages, and management quality. One of the benefits of social media is that it has brought news to the hands of common masses. It has brought in new generation of investors, giving them access to information, self-learning tools, and well, new to this channel. And once the transaction fees were eradicated in 2020, the retail investors really poured in. Transaction fees were essentially trade commissions charged for every sale or purchase order, which have been extinct in the US since 2020, first removed by interactive brokers. Now, even though short-term market fluctuations can be difficult to endure emotionally, sticking to the plan and remaining patient through the periods of volatility can prevent you from making impulsive and sometimes expensive decisions. I know it's easier said than done, but detaching emotions from the decision-making process will help you look at market fluctuations as opportunities for buying great stocks on sale, but only after doing due diligence and research. And again, not by following any financial YouTuber or TikToker, myself included, nor that I would ever tell you which stock to buy or sell. Now, how do you actually make money in stocks? What is capital gains? How do dividends work? What are the top 5 myths of stock market? We will discuss all of that in the next video, so be sure to subscribe. Until then, be smart and invest safe.